I think next year, 2020, will be a very challenging year for investors, as was 2019, with low economic growth and low interest rates. And in such an environment, I think investments that have a high dividend yield, sustainable earnings, sustainable cash flow, and strong balance sheets will be very, very in focus by investors. As such, I think global real estate will offer a very interesting alternative to traditional asset classes for investors for 2020. Well, the global property markets are evolving and growing. We see an increase in the number of REIT markets that are established globally, and we also see new types of real estate investment opportunities. We see data centers, we see cell towers, senior housing as areas with very strong secular growth that aren't so dependent on current economic fundamentals. We see this as a very good opportunity to include in a portfolio which brings returns that are not necessarily correlated to the current economic cycle. The US market is the largest market, and we see that as sort of the role model for many of the other REIT markets globally. And we're seeing other markets in Asia starting to develop and grow to become challengers, and also in terms of size and market cap and liquidity, interesting alternatives to the traditional US REIT market. Well, the Asian markets tend to have a very traditional asset class, be it office, retail, industrial. In the other markets, we do find more opportunities. Self-storage is one example, that in the United States, but also increasingly globally, we're seeing opportunities. This is an area where the economic fundamentals are not such an important driver. We see other drivers like consolidation. Another sector could be digital infrastructure, cell towers or data centers, which are benefiting from investment in data. 5G and other networks that are being created are creating a lot of demand for data centers. Cell towers are necessary for driverless cars, as well as 5G. We're very optimistic for Asian REITs in 2020. Asian REITs' balance sheets are very strong. The economies have been growing at slower rates due to the trade frictions and also other issues that have impacted the markets. Specifically in Hong Kong, the protests have definitely had an impact. But we see very, very deep value, good balance sheets, share buybacks, and other potentials to unlock value. Japan is our preferred market, given the strong growth that we see in the office market. Also in the logistics market because of e-commerce and other demand drivers in logistics. So we see a lot of things we like in Japan. Australia, with its high dividend yields and low bond rates, is also a very, very attractive market. So we see Asia as being a very, very strong contributor to our growth next year. Well, trade wars, recessions, slower economic growth are not great for any type of asset. However, REITs, being very defensive and having very strong cash flows, typically will outperform in such an environment, being defensive stocks. And we've seen this to some degree this year. With expectations for lower growth and lower interest rates, we've seen the REIT markets perform very well globally. One of the factors has been the slower growth outlook. Moving into 2020, it's hard to imagine that we're going to see an acceleration. And in such an environment, we think, again, investors would look for stable dividends, stable growth, and that's what REITs offer. Well, we believe that REITs give you an opportunity to really diversify a portfolio. The performance versus equities and versus fixed income is not strongly correlated, and this adds value to any portfolio. Also, global real estate securities have different types of real estate. So you can blend a portfolio with many different types of returns. As mentioned, there are data centers, there are also office and retail. Each one is driven by different fundamentals. So in a global real estate sector fund, you're getting diversification across asset classes, across countries, and at the same time, there's one common feature, you're getting income. And income, we believe, will be very important in 2020 and going forward, especially in a low growth environment with interest rates remaining low.